Is real estate actually still a good investment, or is that just something people keep saying because it used to be true? Depending on who you ask, you'll hear, real estate is dead. It's the safest investment ever. Or you're crazy to buy right now. So today, we're cutting through the noise and looking at the real numbers. Not hype. Not tech gurus. Actual math. By the end of this video, you'll know when real estate still makes sense, when it absolutely does not, and how to tell if your deal is good or bad before you buy. Let's get into it. Section 1. Why people are doubting real estate. First, let's address the elephant in the room. People are skeptical about real estate right now for three main reasons. Number 1, prices went up fast. In many areas, home prices jumped 30 to 50% in just a few years. That makes buyers nervous about buying at the top. Number 2, interest rates are higher. Higher rates mean higher monthly payments, sometimes dramatically higher. And number 3, other investments look easier. Stocks, index funds, even high-yield savings accounts feel more passive than dealing with tenants, repairs, and property taxes. So the question isn't, is real estate popular? The question is, does the math still work? Section 2. How real estate actually makes money. Real estate makes money in 4 main ways. 1. Cash flow, monthly income after expenses. 2. Appreciation, the property increases in value. 3. Loan paydown, tenants pay off your mortgage. 4. Tax benefits, depreciation and deductions. Most bad real estate advice focuses on only one of these. Smart investors look at all 4 together. And cash flow. That's where the truth usually lives. Section 3. The real cash flow numbers. Let's look at a simple example. Say you buy a rental property for $300,000. Here's a realistic breakdown. Mortgage, taxes, insurance, $1,800 a month. Maintenance and repairs, $300 a month. Vacancy and management, $200 a month. Total monthly costs, $2,000. Now let's say you rent it for $2,600 per month. That's $300 a month in cash flow, or $3,600 per year. Now let's look at your investment. If you put 20% down, that's $60,000. Your cash-on-cash return is $3,600 or $60,000, 6% annually. That's not amazing. But it's also not terrible, especially when you factor in rent increases over time, mortgage balance going down, potential appreciation. But here's the key point. Most bad deals fail at this step. If the numbers don't cash flow conservatively, walk away. Section 4. The appreciation trap. This is where people get burned. Many buyers say, "I'm okay losing money monthly because the property will appreciate." That's not investing. That's speculation. Yes, real estate tends to appreciate long term, but appreciation is market dependent, is unpredictable short term, and does not pay your bills. Smart rule of thumb: if appreciation disappeared tomorrow, would this deal still survive? If the answer is no, don't buy it. Section 5. The true power, leverage, and time. Here's where real estate still shines. Using leverage responsibly means you control a $300,000 asset with $60,000. Your tenant pays down the loan. Over 30 years, that mortgage goes to zero. Let's say after 25 to 30 years, property value, $500,000. Mortgage balance. Rent, significantly higher than today. That wealth wasn't built from monthly cash flow alone. It was built from time plus leverage plus patience. But, and this is critical, only deals that survive the early years get to enjoy this payoff. Section 6. When real estate is still a good investment. So, is real estate still a good investment? Yes. The deal cash flows conservatively. You plan to hold long-term. You account for repairs, vacancies, and bad months. You buy based on numbers, not emotions. No. You're counting on appreciation to save the deal. You can't afford unexpected expenses. You hate involvement and want zero responsibility. You're stretching your finances to just make it work. Real estate isn't passive income. It's delayed gratification income. Real estate isn't dead. But bad deals deserve to be. And if this helped you think more clearly about investing, hit like, subscribe, and I'll see you in the next one.